In today's episode, I'm just going to concentrate on the cash budget, but just the 4 statements that normally has to be done when you do a cash budget. Now, if you want to do it from the textbook, I'm using the Accounting Concepts and Application textbook, 4th edition, Philippa Greig one, and I'm doing exercise 14.15, and that's on page 730. Now, students normally get the exercise in the book or on a test or an exam printed on paper. And what I say to my students is when you do the input sheet, you basically copy all the information in the exercise into your input sheet. So you put everything in there plus details, percentages, etc., etc. So that once you finish your input sheet, you can basically close your textbook. You don't need it. Now, I'm not going to concentrate on the input sheet. I am just going to look at the 4 statements today. And to make it easier, instead of flicking around from the statement page to the input stage, I've actually copied and pasted some of the information on this page just because I'm going to use it in my explanation. So the first statement we're looking at is a statement of expected accounts receivable. Another word for accounts receivables could be debtors. In other words, what are we trying to work out here is we have credit sales to debtors or accounts receivable. How will they pay us back? In other words, remember, a cash budget is a prediction of the future of monies or cash paid and cash received. So I've copied and pasted the collection pattern, and it says there, in the first month after the sale, we will get 30% back, second month 50%, third month 20%. So I've listed my credit sales. Now remember, this is only credit sales because cash sales is recorded in the month we receive it. So another thing that is important, because if we look here at December and we say 30,000 credit sales, how will it be collected? 30% in the month after. So if you look at December, in January, we will get 30%. In February, we will get 50%. Now, January and February is not part of our 3-month budget period. So we're going to look at December and say in the 3rd month, in other words, January, February, in March, we will receive 20% of the 300,000 credit sales. Right, so there is the 60,000. Now you can see in my formulas, I did do it properly from the input sheet, but as I said, I've just copied and pasted. Yes, I'm not going to jump in between the sheets. So 20% of 300,000 is that 60,000 that we will receive in March. If we look at January's credit sales, 330,000. The next month we will receive 30%. The next month is February, so it's not part of my 3-month budget. So January's first amount that we're going to receive that is part of this budget is 50% in March. So 50% of that in March, and in the 3rd month, April, we will receive 20% of the 330,000. So in April, we will receive the 66,000. I'm going to do one more. So if we look at February, and they say in February, the 1st month after, which is March, we will receive 30%. So 30% of 363,000 is your 30% is there, $108,900. The next month we receive 50%, and you can see the increase there, 50% of that. We will receive that, and then also 20% in the 3rd month. And this is how you continue working your statement of expected accounts receivable. In the end, it's these totals that you're going to show in your cash budget. Now, I'm not doing the cash budget as per se today. Moving on to our statement of accounts payable. In other words, how does the business pay its creditors? In this exercise, it said we will pay them in the month following. Now, the first thing we had to work out is what are the credit sales. In this exercise, they didn't give us the amounts, but they said credit sales are 30%, credit purchases are 30% of credit sales. I'll say that again. Credit purchases are 30% of credit sales. So you had to calculate the credit purchases amount. So I've just shown you quickly December's credit sales, 30% of that. So in December, our credit purchases will be 90,000. Of the credit sales in January, 30% of that will be the 99,000, which is our credit purchases. Now, which month is important to us? February, because why? February's amount will be paid the month after, which is March. So let's quickly work out the credit sales. There is February's credit sales. What is 30% of that? And you can see I've put it there in the orange circle, 108,900. And that's the amount we put in February's column. Okay, if you look then at March, 30% of that gives you the credit purchases of 119,790. And that's how you continue. The 30% of April is your credit purchases. Now I've done it there as well, and I've copied and pasted this from my input sheet because I want to explain it in the next one when we come to GST. All right, so firstly, if we just close off with a statement of accounts payable, these amounts we got from 30% from our credit sales. And that's where we got all these amounts from. Now they said we will pay our credit purchases. In other words, we will pay our creditors the month after in full. Now, this is great for building up a credit rating. However, if you look at a cash flow situation, this is better for you to actually negotiate with your suppliers, your accounts payable, that you can also pay them off over a few months, because we are only receiving money from credit sales scattered over 3 months. So yes, it gives you a good credit rating if you pay the complete debt the month after, but it could lead to cash flow problems. Coming to GST receivable and the statement of GST payable as well, this is slightly more complicated. Here we're looking at the principle. All inventories purchased, all expenses paid that GST is applicable on, and all assets that we buy, we will claim the GST back in the month following. Right, so let's start off with GST receivable. In the month of February, and I start with the month of February because all the items involved with GST we will claim back in the month after, which is March. So that's why February is important here. Now, I've shown here in blue, when we talk about purchases of inventories, we talk about the total amount of purchases, the cash purchases, plus the credit purchases. Now remember, we've already calculated the credit purchases when we did our statement of accounts payable. So it's that total amount in blue that becomes my purchases here. The same with March, it is the total amount, 90,000 plus 119,790 gives me my total purchase of inventories. And the same for April, 120,000 plus 131,769 becomes my total purchases. When it comes to expenses, these are only expenses that has GST on them. For example, wages is not part of this. Interest is not part of this. And I'm just going to jump here to my input sheet to show where did we get the 27,000. If you hop into your input sheet, you will see selling expenses there, 32,000 for February, but it includes depreciation. Now, depreciation is an imputed or calculated expense. In other words, there's no GST applicable. So we got to say the expenses for February is 32,000 minus the 5,000. For March, it will be the 35,000 minus the 5,000. And that's how this will continue. So if I get back to my statements, and I'll just remember this one, 32 minus the 5,000. If we look then at our expenses for February, that's where we get the 27,000 from. How did we get this 30,000? It was the 30,000. It was the 35,000 minus the 5,000. Okay, so in these examples, we less or distracted or minus our depreciation of 5,000. Now, assets is tricky because when do we claim GST back? It said that we're going to buy assets in March with 80,000 equipment. It says, however, we're going to pay it off over 3 months. However, when it comes to claiming the GST, we claim the total amount of GST in the month that the transaction takes place. So that's why the 80,000, the total amount, will be put into the March month column. So how do we get the GST now? All right. You can see that I said inventories, cash purchases plus accounts payable, credit purchases. That comes from those amounts there. So I've already explained that, but in case you were wondering what this means here. So now we got to calculate the GST. In February, we are purchasing inventories. We paid for expenses. How much GST can we claim back? It is the total, if you look at my formula there, B23 plus C23 gives me that total, and you just divide it by 11 because those amounts are GST inclusive. If we look at April, we're going to add up all three of these amounts, and you'll see it in my formula now. You see the B24, C24, D24 divided by 11. Here we look at B25, C25 divided by 11, right? And that is GST we're going to claim back in those months. The last one, GST payable, is a bit less complicated than GST receivable. We look at sales, and that's our total sales. If you do get revenue, in other words, if your business renting out property to another business, GST is applicable. Commercial rent, in other words. If you sold an asset and you claim the GST, you'll have to pay that back. So in this exercise, it was just straightforward. Our total sales, we divide that by 11. And also, if it happens in February, we're going to pay it over to the tax office the month after. So that's just a quick explanation of the 4 statements. I hope that helps.